Welcome to the Explainer. So, if you've been tracking corporate sustainability, you already know the reporting landscape has historically been, well, an absolute maze. Just conflicting frameworks and voluntary guidelines everywhere. But today, we're dissecting the antidote, and that is IFRS S1. We're going to demystify exactly how this standard is transforming those dense, fragmented rules into a crystal clear, unified blueprint for global corporate transparency. If you want to understand how the future of corporate sustainability is actually being standardized for capital markets globally, you are in exactly the right place. Okay, let's dive into this. Here is our roadmap for today. We'll start with the global language, then meet the ISSB. After that, we'll look at the objective of IFRS S1, the cash flow connection, the 4 core pillars, and finally, wrap up with a final thought. All right, Section 1, the global language. Before we even get into the sustainability side of things, we really have to look at the massive reporting infrastructure this whole new framework is built on. 140. That is the number of jurisdictions around the world where companies are already required to use IFRS accounting standards for their financial health reporting. It's huge, right? These standards act as the dominant, unified global language of finance. It's literally what allows an analyst in Tokyo to effortlessly read the balance sheet of a company based in Toronto. And now, the IFRS Foundation is applying that exact same unified, rigorous philosophy to sustainability. They are effectively ending the era of fragmented ESG frameworks by building sustainability reporting right into that existing, universally understood language of global financial markets. Moving on to Section 2, meet the ISSB. To really grasp this standard, we have to know who's writing it. Enter the ISSB. That stands for the International Sustainability Standards Board. They operate right inside the overarching IFRS Foundation as an independent standard-setting body, and their core mission is absolutely vital. They are shifting corporate sustainability from being this sort of fluffy public relations exercise into a rigorous, data-driven dialogue between investors and companies. They're developing globally comparable disclosures that are specifically designed to give investors decision-useful information. They aren't just asking for data so a company can check an environmental or social box on a glossy marketing brochure. No, they want to ensure the data you analyze actually reflects the true operational and financial realities of the business. That way, we can finally have genuine comparability across industries and borders. And what's truly fascinating about all this is the sheer speed of the rollout. It perfectly reflects the massive, urgent market demand for standardized data. The ISSB published their exposure draft proposing these requirements in March 2022. Then, following a ton of intensive market feedback, just over a year later, in June 2023, the official standard was issued. And by January 1, 2024, it became officially effective for annual reporting periods. In the notoriously complex, usually very slow-moving world of global financial regulation, going from draft to effective standard in under 2 years is a blistering pace. Capital markets demanded clarity, and the ISSB delivered it fast. Section 3, the objective of IFRS S1. So the crucial point is, what's the ultimate endgame here? Well, the standard explicitly states its objective is to require an entity to disclose information about its sustainability-related risks and opportunities that is useful to users. Notice those exact words, useful to users. The objective isn't about saving the world on paper, it's about giving the primary users of general-purpose financial reports, meaning you, the investors, the analysts, the lenders, the exact concrete information you need when deciding whether to provide resources to an entity. It's a framework of radical transparency, built from the ground up to fuel highly practical, informed financial decision-making in capital markets. Let's jump to Section 4, the cash flow connection. And this brilliantly illustrates the heart of the standard. Under IFRS S1, a company has to disclose information about any sustainability-related risks and opportunities that could reasonably be expected to affect 3 specific things: its cash flows, its access to finance, or its cost of capital. This is the core concept of financial materiality. So, whether the timeline is short, medium, or long-term, if a sustainability issue, say extreme weather continuously disrupting a crucial supply chain, or a new carbon tax eating into profit margins, if that is going to move the needle on those 3 financial drivers, it has to be disclosed. It completely shatters the barrier between a company's sustainability profile and its actual bottom-line prospects. Sustainability data, it's now explicitly treated as financial data. Let's move to and see how this builds in Section 5, the 4 core pillars. Now that we know the why, we really need to know the how. IFRS S1 requires companies to filter every single identified sustainability risk and opportunity through a highly structured architecture made up of 4 specific pillars: governance, strategy, risk management, and metrics and targets. Now, to be clear, this isn't some optional formatting suggestion. It is the mandatory structure for disclosure. Let's break these down one by one so you know exactly what you're looking for when you open one of these newly standardized reports. Pillar 1 is governance. This requires a company to lay out the exact processes, controls, and procedures it uses to monitor, manage, and oversee sustainability risks and opportunities. Think of this as the structural accountability layer of the business. As an investor, you want to know who is actually in charge of this. Is there a dedicated board committee overseeing these issues, or does it just sit somewhere with middle management? What internal controls ensure these risks are actively managed and actually surface to leadership, instead of just being ignored until a crisis hits the news? It basically outlines the entire human and procedural architecture handling these risks. Once that governance is established, we roll right into Pillar 2, which is strategy. What is the entity's specific approach for actually managing these identified risks and opportunities? This is where companies are essentially forced to clearly explain their actual game plan and their operational adaptability. For example, if a major physical climate risk threatens their main manufacturing hub in the next 5 years, or, on the flip side, if a shift toward green technology offers a massive new revenue opportunity, how exactly is their corporate strategy adapting to survive or capitalize on that? Investors absolutely need to see that the business model is resilient enough to handle the reality of the risks they've identified. Next up is Pillar 3, risk management. Now, while strategy is kind of the what, this pillar is the strict mechanics of the how. IFRS S1 says companies must outline the precise processes they use to identify, assess, prioritize, and monitor these risks. This pillar, honestly, it completely invalidates those vague corporate statements about just caring for the environment. A company has to show its operational homework here. They have to prove to you exactly how they determine which risk is, say, an immediate existential threat requiring capital allocation today versus a lower priority, maybe longer-term issue. It details the actual machinery the company uses to continuously scan its operating environment for emerging threats. Finally, we reach the 4th pillar, metrics and targets. This is where the mathematical reality sets in. Companies have to disclose their quantitative performance in relation to these risks and opportunities, showing hard, verifiable progress towards targets they've set internally or targets that are legally required. This really strips away the potential for greenwashing. It's the actual measurement and tracking phase, giving analysts the raw data needed to verify if a company is truly executing the strategy it claims to have on paper. Basically, if a company says it's mitigating a risk, this pillar is where they have to prove it with consistent, comparable numbers over time. And that brings us to Section 6, Final Thought. We've journeyed all the way from the macro scale of 140 global jurisdictions, right down to the micro scale of internal corporate metrics, governance committees, and risk tracking. And it all leads to this stark, provocative question. If a company cannot effectively measure, manage, and report its sustainability risks using these 4 rigorous pillars, can you truly trust its financial future? In the era of IFRS S1, treating sustainability as some secondary, non-financial issue is simply no longer an option. The deep, systemic connection between sustainability and cash flow is now officially codified into a global language. Thanks for diving into this explainer with me today, and keep questioning how we measure the true value and resilience of the companies building our future.